Hello and welcome. Today, we're going to tackle one of the most fundamental concepts in all of tax law, the specific rule that brings a sense of order to what can feel like total financial chaos. This analysis has been prepared by Dr. Samir El-Rashani with AI support.
When you get to the end of a financial year, it's a mess, right? You've got income, losses, investments, expenses. It's just this big jumble. But what if I told you there's an exact blueprint, a precise set of instructions buried right inside the Income Tax Act, designed specifically to bring order to that madness? Well, today, that's exactly what we're going to explore.
So, here's our game plan. First, we'll look at that financial jumble. Then, we'll uncover the specific rule that sorts it all out. After that, we'll break down the calculation blueprint itself, see how it works with a real example, and finally, we'll talk about why this is all so important, especially when we've all got software to do it for us. Let's get right into it.
Okay, so let's picture a typical year. You've got your salary from work, maybe some extra cash from a rental property you own. You did pretty well on some stocks you sold, so that's a nice gain. But that little side business you started, yeah, it took a loss in its first year. And of course, you were responsible and put some money into your retirement savings. It's a lot of moving parts.
So here's the million-dollar question. With all these different things going on, money coming in, money going out, gains, losses, how on earth does the tax system combine all of that into one single, logical number to figure out your tax? It looks like total chaos from the outside, but believe me, there's a very clear method at work here. The very first thing the Income Tax Act does is sorts all that chaos into different categories. I like to call them buckets. As you can see, there's a bucket for your job income, that's subdivision A, another one for business or property income, subdivision B, a separate one for your capital gains and losses, C, and so on. This sorting process is the absolutely critical first step to creating order.
Okay, so we've sorted everything into the right buckets. Great. But now we need the rule book, right? The actual instructions on how to add and subtract them all. And that rulebook, well, it's found in one single incredibly important section of the legislation. And here it is, Section 3 of the Income Tax Act. In the world of tax, we call this the ordering rule. You can think of it as the official, non-negotiable instruction manual. It tells you the exact sequence you have to follow when combining everything we just sorted. It's not a suggestion, it is the rule. And there's a really good reason it's so strict. It makes sure the system is fair and stops people from using certain losses to shelter the wrong kinds of income.
Now, before we get into the steps, there's one quick term we need to get straight: taxable capital gain. So when you sell something like a stock, the profit, the sale price minus what you paid for it, is your capital gain. But you don't actually include the whole amount in your income. You multiply it by something called an inclusion rate, which is currently 50%. And that final number is your taxable capital gain. We're going to be using that term in just a second. All right, now for the main event. Let's look at the blueprint itself. Section 3 can be broken down into 4 clear, sequential steps that you absolutely have to follow in this exact order. No skipping ahead. Here they are. Step 1, under paragraph 3A, you add up all your positive income sources, your job, your business, your rental income, all that stuff. Step 2, under 3B, you figure out your net taxable capital gains. That's just your taxable gains minus your allowable capital losses. Third, under 3C, you subtract some very specific deductions like RRSP contributions. And finally, step 4, under 3D, you subtract any losses you might have from a business or property. So, what happens when you've done all that? Well, if you have a positive number left over after step 4, that's it. That is your net income for tax purposes, or NITP. But what if the number is negative? Well, the law says your income is simply treated as zero. And this is a huge point. Your final net income for tax purposes can never be a negative number. Okay, theory is one thing, but seeing this blueprint in action is where the light bulb really goes on. So, let's apply these exact rules to a hypothetical taxpayer we'll call Jane Smith. So here's a look at Jane's year. We've got some positive income, 35 grand from her job, 6 grand from rent. Then some capital stuff, an $8,000 taxable gain and a $7,000 allowable loss. And to round it out, some deductions and losses, a $4,000 RSSP contribution and a $9,000 business loss. This is that classic financial jumble we talked about, and now we're going to sort it out. Okay, let's follow the blueprint step by step. Step 1, paragraph 3A. We add her employment and rental income. Step 2, 3b, we net her capital gains against her losses, which leaves a positive $1,000. That brings our subtotal to $42,000. Next, step 3, we subtract her $4,000 RRSP deduction. And finally, step 4, we subtract her $9,000 business loss. And there we have it. After applying the strict ordering rule of Section 3, Jane Smith's net income for tax purposes is exactly $29,000. See, it's not an estimate, it's not a guess, it is the definitive number that the legislative blueprint gives us. Now, at this point, you're probably asking a very fair question, one I get from students all the time. Professor, why are we doing all of this by hand? I mean, seriously, if tax software can spit this number out in a fraction of a second, why on earth should we bother learning the underlying legislation? It is such an important question for anyone who wants a career in this field. And the answer really boils down to the difference between what and why. You see, using software is all about execution. It tells you what the final number is. It's a tool. But understanding the act, that's about strategy. It explains why it's the right number. One is what a technician does, the other is the foundation of a true professional advisor. Just think about where things are heading. The simple, repetitive stuff is getting automated faster and faster every year. Your real, lasting value as a professional isn't going to be in plugging numbers into a box. It's going to be in your ability to handle complex situations, to give strategic advice, and to understand the law deeply enough to deal with the messy stuff that software just can't. So, I'll leave you with this final thought to chew on. As technology gets better and better at handling the what, the most important question for your career is going to be, how will you prove that your value, your real expertise, is in understanding and explaining the why?